Hey guys, Toby Mathis here, and today we're going to talk about making your side gig tax-free. So if you're like a lot of Americans right now, it's between 30 and 40%. You have a side gig of some type. Maybe it's Uber or Lyft or Turo, or maybe you're Airbnb-ing something, but you have some sort of income that is coming in that is not your W-2 job anymore. You have something on the side. Heck, maybe you're doing some consulting. Maybe you're going online and you're selling hey, I'm doing some editing service or whatever. You're just making money outside of just your W-2 job. Well, let me show you how it works in the tax system. Number one, there's certain expenses that even if we incur and we're using them to help our employer out, but they're not reimbursing us, there's no longer a thing called unreimbursed business expenses that I can write off as a miscellaneous itemized deduction. Why is that? Because in 2017, they did away with miscellaneous itemized deductions under the Tax Cut and Jobs Act, which means I could have a whole bunch of expenses that nobody's paying for except for me, and I'm paying them after tax. And let me explain how it works. I have to earn money as a taxpayer, then I pay tax, then I spend. So if I make $1, and I have to pay tax on that of 30 cents, then I might have 70 cents to spend. But what if I have $1, right? What if I had to incur an expense like my friend, the cell phone here, and I'm like, this is really not fair. Somebody else should be paying for that because I'm using it for some business purpose. Well, if you're an employee, you're out of luck. This is the system you're under. However, if you are under, and you're operating as a business, and so you're doing your side gig, you can actually earn money, spend it, and then pay tax on what is left, which if we can get that to zero, then you pay zero tax. And that's a lot of businesses out there. And by the way, most C Corps actually zero out. And the reason I mentioned that specifically is because if you mention C Corp to your accountant, they're probably going to have a little heart attack and they're going to start doing double tax, double tax, double tax, double tax. When it's zero, it's zero. I don't care if you double zero. Multiply 2 times 0, it's still 0, right? We don't care. There's no double tax when we're zeroing things out. And that's where a lot of you could probably end up. It doesn't necessarily have to be a C Corp, but it's probably going to be a corporation, and here's why. If you are on this system, and you operate a business in your name, and you are called a sole proprietor. In other words, I do not differentiate between me and my business. Now I have to break it in between my personal use and my business use. That sounds really weird, right? Like if I had an employer, they could just reimburse me. Again, I'm going to use the example of my phone. They could reimburse me 100% of my phone cost and my data and my cell, whatever that might be. Maybe it's $200 a month, right? And they could reimburse 100%. I get tax 0 on it. They get to write it off 100%. In other words, a write-off is a deduction. If they make $100 and they give me $100, they pay 0, right? That's where I want to be. I can't do that over here. I actually have to set myself up as a business. In order to do that, I need to be an S Corp, a C Corp, an LLC taxed as an S Corp, or an LLC taxed as a C Corp. Now, a lot of you guys are going, Toby, you're making mumbo jumbo. You talked about a side gig. Why would I incorporate my side gig? Here's the thing. Even if you're already incurring an expense, so let's just say I'll use my cell phone as the example, and I'm spending $2,400 a year on my cell phone and my data. Maybe I buy a computer every year, so I have another $2,000 thrown there. I have housing, and there's a portion of my housing that I'm using for my side gig. If I get away from this, I go into another category where I can actually write off a percentage of not just my home, my mortgage, my property taxes, even my cleaning fees, my utilities and everything else, because I am an employee of an organization. It has to be a business. I cannot be an employee of my own S Corp. I cannot be an employee of my own partnership. I have to be an S Corp or a C Corp from a tax perspective. So I could be an LLC, taxed as an S Corp, I could be an LLC taxed as a C Corp, I could be an S Corp proper, I could be a C Corp proper, but I cannot be a sole proprietorship or a partnership and get this type of treatment. My experience is we're talking about an extra $5,000 a year plus. In many cases, it's much, much more depending on where you live and what your expenses are, because we're getting a percentage of our utilities, we're getting a percentage of taxes, everything else. Plus, you already got the standard deduction. You're probably not getting any benefit out of those things anyway. Now, on top of that, when I have a business, I'm allowed to use something called 280A, and I'm allowed to have business meetings in my home that give me fair market value that I could pay myself, that I do not have to report as income if it is 14 days or less. Airbnb caught on to this and said, hey, when you go on vacation, just rent your house because you don't have to recognize it as income. It's tax-free money. Well, you already are in your home. You're already paying for these things. So let's just say, on average, we're probably talking $500 to $1,000 per meeting times 14. So let's just say on the low end, we have another $7,000. That means we have somewhere around 12, 14, 16,000 bucks. On average, we actually see with our clients, it's over $20,000 a year when you start adding these things up. On average, it's more than 20,000. So I'm just gonna say, all right, 17 grand. What is that worth to you being able to reimburse? Like your first $17,000, if you reimburse yourself, your tax rate is 0. You've already had to pay for these things, but now we are putting all of these up here into the spend category where your tax rate is 0%. Now, if you're a single person and you are making, let's say, $180,000 a year, really good, hey, I got a good W-2 job and I make an extra $20,000 on the side, or my spouse, maybe we're married and we're on a category. I'm gonna use the single because it's a little bit easier for me to kind of follow this. I am literally looking at jumping from the 24% category to the 32% federal tax bracket, which means if I make $17,000, it would be taxed at 32% without even calculating in my state yet. Ouch. Plus I have employment taxes on it. Ouch. Right? I could be hit with the Social Security tax. Old age disability and survivors is 12.4%, Medicare is 2.9%. There's a phase out there, but I'm still getting hit with something on the employment tax front on those dollars. So by the time I'm looking at that, it's more than a third of it's gone. So 30% at least is off the table of that 17,000. So this by itself, if I can set this up as a business, is going to save me $6,000 or $7,000 a year. Every year, year in and year out. For me, that's a really badass vacation that I'm giving up if I choose to operate over here versus here. And that's what we want. If you have a side gig, what we want to do is find things that you're already paying for that we're now able to use for your side business. And we're gonna, like, for example, if you were an Uber driver, your cell phone's deductible, you're gonna be able to get some mileage back on that car that you're already paying for, and you're gonna be able to do these types of meetings and get myself back some money. I'm gonna need equipment. I'm gonna need to have my cell, excuse me, I'm gonna need to be able to have data and cell. I'm gonna need to be able to use my home where I can do my calculation for how much I made and do my taxes and things like that. A little bit harder argument to go all the way and have a meeting every month, but if you have a business, technically, you're supposed to have meetings. So you could have board meetings with yourself and your family. If you blend other businesses under there, it even gets better. If you throw your kids into the mix, a spouse into the mix, it even gets bigger and better. But these types of things will make sure that your income that you receive is offset. It immediately goes into that 0% because you're earning it. Let's say I made $20,000 and I spent $20,000. That means I'm taxed on a big 0. And if I've already been paying for it over here, all I'm doing is reimbursing myself that and writing it off and moving it from one pocket into the next, but magically it's tax-free. And if you don't believe that this is how our tax code is built, like there's something wrong, you don't understand the U.S. tax code. It's about 10% what taxes you have to pay. 90% of it is built around how do you avoid those taxes, and let's give incentives to certain folks so that they can actually make more, in theory, the more you make, the better off the government is. And if you're an employer, even better. If you're a small business, even better, because that's the lifeblood of the country. You could choose to stay over here and forego those benefits, or you could just use those benefits. It's kind of like, hey, I could take a tax credit. I could write certain things off. I don't have to, but I could. And if you choose not to, you're just going to pay a lot more on your income, and you're going to pay a higher tax bill. Or you could say, you know what, I like saving $7,000, $8,000, $9,000, $10,000 a year. When we see sole proprietors go over to S corps, the typical savings is about $7,500 a year, year in and year out, that we see. Because there's some other benefits that we're not even going to jump into. If you have medical expenses, here's another beautiful one. Maybe I set this up as a C corp so I can reimburse, get this, 100% of my medical, dental, and vision expenses. 100%. Not, hey, I have an employer plan and they already pay my insurance. I don't care about that. I get to reimburse anything that came out of your pocket, from co-pays to deductibles to things that weren't covered to things that your insurance doesn't cover. I can reimburse 100% at. And it's just like this. It's called an accountable plan, and I'm able to reimburse it, write it up at the business level, pay myself that money, give myself a reimbursement, and not have to pay tax on it. It's actually pretty fantastic when you start looking at it, and then you realize why accountants and tax attorneys who know what they're doing are telling their clients, stop doing it this way. Please come over here. Please set yourself up as a business. There's asset protection reasons why. There's legacy creating reasons why. There's estate planning reasons why. And there's business reasons why, because you can set up separate credit and things like that underneath that business. But there's also massive tax benefits for doing that way and avoiding some nasty tax surprises over here that you probably don't even realize are lurking underneath the surface. In fact, sole proprietors are about 800% more likely to be audited than an S corp. In some cases, it's 1,600%, depending on how much they make. And sole proprietors, because they're under this system, they lose their audits 94 to 95% of the time. That is actually Table 17B of Publication 55. The last year they actually had 17B, I think it was 2020. Then they stopped reporting it, but you could always look and see what was the audit rate, what was the success rate, and they used to break it out by the schedule and by the income source. They stopped doing that for some reason, because guys like me are probably like, hey, don't do that. They're obviously targeting you. So if you want to have tax-free money, this is how you do it. Hopefully you've learned something today. If you know anybody out there that has a side gig, please share this with them. And if you could, please subscribe.